¿Ya está grabando? Ah, sí. Bueno. Hello, we are team number 5, and this is our final presentation for the Harvard case, Domino's Pizza Enterprise.
Oh, well, first of all, what is the WACC and why is it so important? The WACC is the weighted average cost of capital, and it represents the average rate of return a company must pay to its investors, both in the debt side and the equity holders, for using their capital. The functions of the WACC, or why it is so important, they are that it determines the minimum acceptable return for new projects, first of all. It is also used in net present value and IRR and other valuation models, and it reflects the company's risk profile and capital structure. How is the WACC used to evaluate future projects? Well, first of all, the WACC can be used as an investment appraisal tool, which means that projects with expected returns that are higher than the WACC add value to the company. Second of all, it can be used as a scenario example. For example, if Domino's considers new stores in Japan, the projected return must exceed the WACC to justify capital budgeting. It helps compare projects of different risk profiles. And finally, the WACC gives investors the confidence. Essentially, it just ensures the returns align with market expectations when it comes to the project involved.
Well, now for the case introduction, Domino's Pizza Enterprises, that is DPE, is the largest pizza company in Australia, sought to estimate its cost of capital to guide investment and expansion decisions. Basically, this case challenges analysts to calculate the after-tax cost of debt, the cost of equity, that is via KPM, and the weighted average cost of capital, that is the WACC, under both current and target capital structures. And by analyzing financial data, bond yields, credit spreads, and Bloomberg betas, the goal is to determine the optimal WACC that reflects DPE's true financing cost and supports long-term growth. Also, the key objectives of this case is to estimate the DPE's after-tax cost of debt using government bond yields and credit spreads, to compute cost of equity through the CAPM model, and evaluate current versus target capital structures to find the optimal WACC for future projects. So the current WACC, well, first, for the range, the DPE's current WACC lies between 5.2% and 6.3%, which is a moderately low cost of capital reflecting stable earnings and Australia's historically low interest environment in 2020. Now for the key driver, well, since equity comprises over 80% of total financing, the beta is the main determinant of WACC variation. And for the benchmark, the medium scenario is 5.7%, which best represents DPE's present condition and can serve as a benchmark for evaluating new projects. Then the implication, projects with expected returns above 5.7% at shareholder value. And lastly, for risk insight, we know that a rising beta or increase in debt financing could push WACC above 6%, raising DPE's hurdle rate and reducing investment flexibility.
Okay, the after-tax cost of debt shows that the real cost of borrowing for DPE after considering, the tax deductibility of interest expenses. This means basically that taxes reduce the effective cost of debt, making it a cheaper financing options compared to equity. In DPE's case, the cost decreases from 3.3 to 2.1. This shows that it has a greater financing efficiency. Okay, in this section, we can see, or well, we can analyze how different beta values affect DP's cost of equity using the CAPM model. And we can see that as beta increases from 0.85 to 1.07, the cost of equity rises from 6.1 to 7.5, showing that higher risks leads to higher expected returns. The key idea here is that overall is that the higher the beta leads to a higher risk leads to a higher cost of debt, and a higher cost of debt leads to a higher capital cost.
Okay, so why we chose 5.81 as our optimal WACC? First of all, is because it is a balanced capital structure. The 5.81 corresponds to Domino's target capital structure, where the proper proportion of debt and equity minimizes the overall cost of capital while still maintaining financially stable. And it also has an efficient risk return trade-off. This value reflects an optimal balance between the risk and the return. Using more debt would slightly reduce equity cost, but increase financial risk, while relying too heavily on equity would raise the total cost. So why not pick the minimum WACC? We also calculated a lower WACC that its value was 5.28 using a beta of 0.85, assuming overall optimistic market conditions and underestimating risk. The 5.81 we chose offers a balanced midpoint reflecting a realistic market data and Domino's target capital structure. It serves as a reliable neutral benchmark while allowing for sensitivity analysis between 5.3 and 6.1% to capture optimistic and conservative scenarios. And a 5.81% WACC also creates value. Domino's maximizes its firm value by minimizing financial costs, which supports sustainable growth and shareholder value creation.
So, as a final conclusion, the 5.81% WACC represents Domino's balance and realistic cost of capital. It reflects the target structure with a debt to equity ratio of 18%, but a market-based equity cost and a conservative after-tax debt rate. So it captures the optimal trade-off between the risk and the return, and low enough to support growth, but high enough to maintain financial discipline. Compared to more optimistic or conservative estimates, 5.81 serves as a reliable benchmark for evaluating new instruments, and it also ensures sustainable value creation and shareholder confidence. Thank you.